Welcome to vTalkInsight, Risk Sentiment Daily for April 23, 2026. Equities are still hovering near record highs and credit is firm, even as an escalating Middle East energy shock pushes oil toward triple digits and tests the durability of an AI-led rally. Let's dig into how that tension between strong micro fundamentals and mounting macro risks is shaping today's overall risk sentiment. Across assets, today's picture is best described as resilient but fragile risk-on. Major U.S. equity benchmarks are at or near record levels. The S&P 500 has just added a little over 1%, and volatility has eased back from recent spikes, all pointing to investors still willing to extend risk. This confidence is grounded in powerful micro trends. Earnings revisions for the S&P 500 have moved higher. Reported numbers so far are robust, and corporate margins and household balance sheets in the U.S. remain in good shape. At the same time, tech and semiconductor names linked to artificial intelligence are enjoying exceptional momentum, which is driving index-level strength even as broader participation stays more muted. But the margin for error is narrowing. The effective closure of the Strait of Hormuz, oil prices above $100, pressure on airlines, and lingering uncertainty around Federal Reserve leadership all add layers of tail risk that markets are largely looking through for now, rather than fully pricing. So risk appetite is still in the driver's seat, but it is running alongside very real geopolitical and policy fragilities. One of the strongest supports for risk sentiment is robust earnings and upward revisions. Consensus forward earnings for the S&P 500 have been marked up meaningfully this year, moving from around 357 to 375, and that upgrade has come even as geopolitical noise has increased. The early reporting season is validating those higher expectations. With only a modest share of S&P constituents out so far, sales growth near 10% and earnings growth close to 30% for major companies underline that corporates are still delivering, helped by resilient U.S. demand and disciplined cost control. That earnings backdrop is key for valuation and downside risk. At roughly 20 times forward earnings, the S&P 500 looks stretched on some metrics, but those multiples are seen as defensible as long as rates stay stable and profit growth continues. It also helps explain why investors have been reluctant to repeat last year's aggressive sell-off and instead lean toward buying dips. The main challenge to this driver would be if energy costs begin to erode margins more broadly, or if earnings strength proves too narrowly concentrated in a handful of winners. Layered on top of earnings strength is an AI and semiconductor-led tech cycle that remains a central bullish force. Semiconductor indices are in a record-breaking run, with month-to-date gains above 30% and an unusually long streak of daily advances, signaling intense demand for growth exposure. Behind the price action is real capital expenditure. AI-driven spend is lifting earnings estimates for chip equipment makers, with companies like ASM International guiding well ahead of prior consensus, while data center suppliers and electrification names highlight stronger than expected orders linked to compute and power infrastructure. The broader AI ecosystem is also humming, from cloud providers rolling out new custom chips and tools, to large potential IPOs in space and AI that could rival last year's entire issuance volume. However, this enthusiasm comes with vulnerabilities. Valuations for some AI assets are extremely rich. Venture deals are printing at revenue multiples in the 30s and 40s, and recent cybersecurity scares around powerful new models remind markets that technology risk is not one way. For now, though, the AI cycle is still a powerful magnet for risk capital. A third supportive pillar is resilient U.S. growth and liquidity. Consumer spending is running at about 4.3% year over year, the strongest pace since 2023, and even stripping out higher gasoline costs, the trend is still a solid mid 3%, helped by broad-based wage gains and sizable tax refunds. On the financing side, credit markets remain constructive. Treasury volatility has eased despite Middle East tensions and uncertainty at the Fed, and corporate bond spreads, both investment grade and high yield, are tight, suggesting limited perceived credit stress and healthy access to funding. Market microstructure is also adding resilience. Algorithmic and electronic trading in macro and repo markets has expanded, improving risk transfer, while ETF volumes help channel shocks when underlying bond liquidity thins. Against a backdrop where U.S. equities look structurally less exposed to energy shocks than Europe or Asia, this combination of robust demand, tight spreads, and deep liquidity reinforces a U.S.-centric risk-on stance. Set against those bullish forces, the Middle East energy shock and stagflation risk stand out as the dominant bearish driver. The Strait of Hormuz remains effectively closed despite ceasefire extensions, with tanker attacks, vessel seizures, and ongoing blockades disrupting one of the world's key oil choke points. This has pushed Brent back above $100 and New York crude into the 90s, while physical shortages in petrochemicals and jet fuel are spreading from Asia into Europe. Airlines are already feeling the strain. Jet fuel prices have doubled since the conflict escalated. Carriers are cutting capacity, pulling guidance, and flagging significant extra fuel expenses that squeeze profitability and limit consumer choice. The macro implications are significant, especially outside the U.S. Germany has slashed its growth forecasts, citing higher energy costs and conflict-related uncertainty, and the IMF warns that a prolonged Iran conflict could trim global growth toward 2%, flirting with a near-global recession, particularly for energy-dependent Europe and parts of Asia. Inflation dynamics are nuanced. In the UK, the latest spike is largely energy-driven, with core measures still contained, and weaker real activity in Europe may help prevent a repeat of the 2022 price surge. But as long as the Strait of Hormuz remains constrained and logistical bottlenecks persist, the risk is that elevated energy prices slowly bleed into broader inflation and earnings, challenging the current benign equity narrative. A second key headwind is elevated valuations and concentration risk. Equity gains are heavily focused in a small cluster of large-cap tech and AI-related names, while the broader market is far less enthusiastic, leaving indices more sensitive to any disappointment among their leaders. Semiconductor ETFs are on track for record monthly inflows at the same time as they post outsized price gains, suggesting some momentum and crowding dynamics. Elsewhere, short squeeze-driven moves in names like Avis and Hertz, or late-stage venture deals in AI at very high revenue multiples, reinforce the sense that parts of the growth complex are priced for perfection. At the index level, a 20 times forward multiple for the S&P 500 is seen as reasonable if earnings keep rising and rates remain anchored, but markets acknowledge that levels are stretched after the latest rally. That is why talk has shifted toward a potential consolidation phase rather than a fresh leg higher, and why any negative surprise in AI, earnings, or policy could trigger a disproportionate reaction given how much good news is already embedded in the leaders. The third bearish driver is Fed leadership and policy uncertainty. The confirmation of the likely new chair is being delayed by a criminal probe into the current incumbent and partisan gridlock in the Senate, raising questions about the timing and clarity of future monetary policy decisions. Beyond the personnel drama, there are substantive policy questions. The nominee has floated ideas for a significant shift in the Fed's framework, including less reliance on the current inflation gauges, possible changes to communication tools like the dot plot, and a gradual move toward a smaller balance sheet, all of which could tighten financial conditions at the margin. Markets worry that reduced forward guidance and fewer press conferences could lift risk premia and volatility around meetings, especially if investors are unsure how the new regime will react to an energy-driven inflation shock. For now, bond markets remain relatively calm, with only modest rate cuts priced and Treasury volatility contained, but this calm could be fragile if political interference fears intensify or the policy pivot proves more aggressive than currently assumed. To sum up, risk sentiment today remains firmly, but not complacently risk-on. Robust earnings, an AI and semiconductor-led tech cycle, and a resilient U.S. growth and liquidity backdrop are still carrying equities and credit, yet they are increasingly offset by a deepening Middle East energy shock, stretched leadership valuations, and unresolved uncertainty around the future of Federal Reserve policy. The balance of these forces suggests a market that can tolerate shocks, but only up to a point, making the energy path, earnings breadth, and policy communication the critical variables to watch over the coming weeks. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.